Good evening, my all dear students. My name is C. Divas Gupta, and today we will discuss and we will continue on our discussion on the dividend decisions. Good evening, Sushil. Good evening, Tanu. Good evening, Pratiksha. So, students, as we have studied in our previous session, the basic concepts on the dividend decisions, we have studied some of the different types of theories. Good evening, Sandeep. Good evening, Ajay. And after that, we said that in this particular session, we will try to cover up some more questions so that there is a proper revision that happens on those concepts. So let us start with the question number 11, and then we'll try to solve as many questions as possible today. Okay, students, I hope you all have revised whatever we studied, so we can build upon our understanding from here upon. Yes, students. Question number 11 says that the following information pertains to Messrs. XY Limited. Earnings of the company is rupees 5 lakhs. Dividend payout ratio is 60%. Number of shares outstanding is 1 lakh. Equity capitalization rate. So equity capitalization rate is KE. And rate of return on investment is R, which is this. Calculate the market value per share as per the Walters model. So students, we have already studied the Walters model, how to calculate the market price as per the Walters model. Good evening, Meman. Good evening, Charu. So let us start. Let us write the formula first of all. As per the Walters model, we know that the price is equal to D plus earnings minus dividend, which is nothing but the retained earnings. On that, R divided by KE, whole divided by KE, right? This is the formula given by Walter. Now, if we try to put the things, so first of all, earnings, total earnings is how much? 5 lakh rupees. Number of shares is equal to 1 lakh rupees. 1 lakh numbers. So 5 per share is the EPS. And hence, the dividend per share is how much? 5 into 60%. Right? Because 60% is the dividend payout ratio. So hence, the dividend per share comes out to 3 rupees per share. Now, we can substitute all the information in the formula. 5 minus 3 multiplied by the R, which is the rate of return. The internal rate of return that the business earns is 15%. Now, students, from here only you can see the business is giving more returns than the expectation of the shareholder, because 12% is what a shareholder expects. 15% is what the company gives as a return. Multiplied by 15% divided by 12, whole divided by 12%. Good evening, Khushi. Yeah, let's go down and we'll just try to solve this. 3 plus 2 into 15% divided by 12%, whole divided by 12%. If we solve this, we get rupees 45.83 per share. This is the market price per share, right, students? Very easy, very simple. Just we have taken the information from the question and applied it in the formula. Now, the second part of the question says that let's go to the second part. It asks us optimum dividend payout ratio according to the Walters model and the market value of company share at that payout ratio. Now, students, it is very straightforward. We know that R is actually greater than KE. That means the company is giving more return as compared to the expectation. Good evening, Harsh. So what will happen? In such a case, the best wealth maximization principle is to keep all the monies with the company, and hence the dividend payout ratio should be 0. So the dividend payout ratio optimum, right, would be 0%. Now, in such a case, they are asking us to calculate the price per share. So price per share will be 0 plus 5 minus 0 multiplied by 15% divided by 12% and whole divided by 12%. Simple. Everything else remains same except for the dividend, which becomes 0. So the per unit price is 52.08 per share. Now students, there is a clear increase in the valuation, right? So price is increased to rupees 52.08 per share because we are following the optimum dividend policy as per Walter's theory, as per the Walter's model. Okay. Yes, Gajar, your answer is right. 45.83 for the first part. Okay, students. So this was a very easy and very simple question. Let's quickly move forward because we have a lot of questions to solve today. Okay. This was a very simple data driven question. The data has to be put in the formula. Now coming to question number 12, students. Okay. Taking an example of three different forms, that is growth, normal and declining, calculate the share price using the Gordon's model. So they're asking us to calculate the share price using the Gordon's model. First of all, let us revise, students. What was the formula? As per the Gordon's model, E1, 1 minus B divided by KE minus B into R, right? This was the Gordon's model. So to calculate the price at today, we will take the earnings after 1 year and then multiply it by 1 minus retention ratio and divide it by the K minus growth. Now let us see the results, the data points that are given in the question. So R is given as 15, K is also given in all the three scenarios, earnings given, B is given, and 1 minus B is also given, right? So let's calculate for growth, normal, and last one is declining. Right? Now let us try to put the formula. So for the growth form, what is the EPS? 10 rupees. 1 minus retained earnings, which is 0.6. Right? Whole divided by what is the KE? 0.10 minus B into R. So B is what? 0.6. R is what? 0.15. Very easy. So this will be 4 divided by 0.10 minus 0.09, which is finally equal to 400 rupees. Right, students? Now, what about the normal form? For the normal form, the EPS is again 10. EPS is 10. Retention is also 0.6. 1 minus 0.60 divided by what is the KE? 10 percentage. R is 10 percentage, right? So 0.1 multiplied by 0.60. So if we solve this, this is again 4 divided by 0.10 minus 0.06, which is a form. It is also variable. Yes, yeah, definitely. Discount rate is also variable. See, practically, if you see every variable, every metrics change in every second. So the discount rate also, the expectation rate also, everything is keeps on varying. Even so, that's why we have also seen one question in which for some time or while studying in the previous example in the previous session, I have told specifically that for some particular time, let's say for 1 year, this discount rate is applicable. For the next year, some other discount rate is applicable. So that can also be there. Okay. Okay, let me wait for a moment. I think there is some network gap again, as many of you are saying video is buffering. Meanwhile, I'm projecting that part of the screen where Okay, students, now let me come back to the questions. I hope the video issue is resolved, or still students were facing some issue in the buffering. Please give me a heads up if I can start question number 13. Okay. Saurav is saying there was a breakup. Now, okay. Vijay is saying Vrinda is saying first question. Okay. Okay, Vrinda. I'll just project the first question again. See, this is the first question that we solved today. The first part in which we calculated the EPS and DPS. Okay. And this is the next page of the same question. Okay, Vrinda? Okay, let me move forward because we have limited time today and we have a lot of things to do. So, question number 13, students. The following information is given in case of Aditya Limited. So, earnings per share is given as 60, capitalization rate is given as 15, R is given as 25, KE is given as 15, dividend payout is also given as 30%. Compute the price using the Walters model. So, we can just simply apply the Walters model. E is equal to D plus E minus D, R divided by KE, whole divided by KE. So students, please put the numbers because everything is given to us. Earnings per share, dividend, everything is given to us. If we solve this, the answer comes as, I'm just directly putting the answer here. We are not going to solve this. It is coming as 586.67. Okay, students? Because it's just as per the same question that we did earlier, right? Only the numbers have changed. Now, the second part is why I've taken this question. What would be the optimum dividend payout ratio under the Gordon's model? Now, students, in the previous question, the first part also, they were asking us to calculate using the Walters model, and the second part also. Okay, but in this part, they are asking about the Gordon's model. So students, please don't worry. The optimum dividend payout ratio as per Gordon's and Walter would be same because both of them are comparing R and KE, right? In this case, since R is greater than KE, hence the optimum dividend payout ratio will be 0. I think all of you agree. So optimum dividend payout ratio is equal to 0. Okay, students? Yeah, Saurabh saying there was a breakup. Jamil, now it is okay. Vasu, please explain the thing which you were telling while solving the declining part. Okay, Vasu. Wait, let me go back to the previous question. No, so while solving the declining part, I had got one query which I was saying is that whether the discount rate is variable or not. I was saying that yes, the discount rate is variable. It can change every second, every 2 minutes. So the discount rate is not fixed because we have also discussed sometime in our previous classes that for 1 year it can be different, for the next years it can be different depending on what is the expectation to discount it. Okay. Harsh, uh, Harsh is asking, sir, does ICAI provide face-to-face classes of these lectures? I don't think so, Harsh. That is provided currently. Any face-to-face class is not provided, at least by the BOS, by the Board of Studies, I'm saying. Maybe the regional offices must be providing, that also I'm not sure, but at least the Board of Studies is not providing any face-to-face. Everything is virtual. Sandeep is saying now it's fine. Kushi is saying video is clear. Charu, it is fine, but we didn't get question 12 as the screen was not proper. So this is the question number 12, Charu. Again, I have just displayed it. Same as last question, right, Gajar? Sandeep is saying, okay, yeah, sure. Okay, students. So this is question number 12 that we have already discussed. And then question number 13 as well. So question number 13 is as good as question number 12, except for the fact that it is asking as per the Gordon's model. It will remain same only, students. There is no change in that. Okay. Now, students, please pay your attention here again. Okay, I am going to discuss some of the incremental things that we have not discussed last time. So, students, I hope all of you know that what is a PE ratio. I'm saying important concepts. Okay, these are some of the additional things that we are going to discuss that some of you might know this, right? So, first of all, there is a concept called PE ratio, right? What is a PE ratio? Market price per share divided by the earnings per share. Simple. Market price per share divided by earnings per share. Now, for example, there is a market price of 1,000 rupees and there is a earnings of 20 rupees. So that means we say that the PE multiple is 50 times. That means the value of that company is 50 times what it earns in a single year, right? In a single earnings, what it earns, right? It is basically keeps on changing. So what if we have to calculate the PE ratio? We can just simply take the MPS divided by the EPS. But what if we calculate the EPS? So similarly, in these three variables, so I'm saying in these three variables, if any two variables are given, the third variable can be taken out. Right, students? That is what I'm trying to say. And the next part, yes, Gajar, you are right. MPS divided by EPS. That's the ratio. The next part which I'm trying to say is, what if we do like this? What is this ratio called? EPS divided by MPS. What is this ratio called? If we reverse the PE ratio, what is this ratio called? Not ratio, but what is the reversal of this? This is called as KE. The cost of equity, right? Market price per share is always from the perspective of the market. This is not the face value per share, right? This is the market price per share that is existing in the market. Now, on this value, whatever is the earnings that are happening, right? This is what the expectation is of the shareholder, which is the KE. The cost of equity. The cost of equity is this much, because today, if the company wants to go and raise some funds, the company will be able to raise at this much. And if the investor wants to invest, the investor would also be able to invest at MPS. Hence, we say that EPS by MPS, or we can also say that 1 by PE ratio is equal to KE. This is a very important relationship, students. Yes, Gajar, cost of equity, right? Mancha is asking, sir, but discount rate is IRR. It should not get affected by external market forces. Only hurdle rate or cost of capital is affected by external factors. Each second, I am right. So, okay, Mancha, let's not mix two things. One is for the purpose of capital budgeting. We have studied that there is a discount rate, right? But if you practically see in the market also, the discounting happens. How the discounting happens? See, there is a future value and there is a present value. And the future value and present value, how it is done is, there is a discounting rate that is taken, and the discounting rate is dependent on what? On the ongoing interest rates, right? As I already discussed, because it is essentially the interest rate itself. Now, since interest rates are also not constant, so practically it keeps on changing, is what I'm trying to say. But for the capital budgeting decisions, if you are trying to calculate the IRR or the discount rate, so there are almost 99% of the situations where we have assumed it to be constant. Okay. And okay, now I'm able to get your question. You are actually saying that discount rate is IRR, which is the internal rate of return. So here, what I'm trying to say, Mancha, is that see, we are discounting using what? KE rate, right? Cost of equity, which is the market-led expectation, right? Not the internal generation of the profit of the company, right? Whatever is the internally generated profit of the company, that is IRR, internal rate of return, that is R. Correct? That we will be able to compute after, let's say, a quarter, after, let's say, a year, once the results are finalized, right? But this KE is actually dependent on MPS, which is market price per share, which keeps on changing every second. Okay? Okay, Minsha, I hope I am able to give you a answer here or a perspective here. Okay? And so this is first. Then second is, what is R? R is also actually EPS divided by equity share. We can say face value plus reserves and surplus per share, right? So what is the book value? So we can say that R is actually EPS divided by the book value per share, BVPS. That is also right. That is called as R because this is internal. Internal means whatever is the book value that the company is holding and whatever is the company is earning, if we divide that, we will come to R. Correct? So students, these are the two important things. Okay, Mansha, thanks. So these are the two important relationships. This is one and this is second that I wanted to tell you, and the PE ratio as well. Okay, students? Now let us go. The question number 14. The dividend 40 is equal to DPF. This, what I have written is right. The dividend payout ratio is equal to 40% of the earnings, 40% multiplied by the earnings per share. This is for H Limited. If the company follows traditional approach to dividend policy. So what is a traditional approach? What was our traditional approach, students? I told you that is Graham and Dodd model. So traditional approach is actually Graham and Dodd model. As per that model, what is the price? P0 is equal to M D plus E divided by 3. Right, students? This is what the price as per the traditional model is. Now, if the company follows the traditional approach to dividend policy with a multiplier of 9, that means M they have given us 9, compute PE ratio. Simple. They are saying compute PE ratio. So students, first of all, if I put what is a PE ratio? Just now we have studied MPS divided by DPS. Market price per share divided by the dividend per share. Now, if we put everything here in the formula, right? M is what? 9. Now, instead of D, can I say EPS into 0.4? 0.4 into E plus E divided by 3. So students, what we have done is we have substituted, yes, Jyot Kumar, you're right, MD plus E by 3. So what we have done is we have just substituted the D from this, which is EPS into 4, right? And essentially what we have done is now everything we have converted in the form of price and earnings, which that is what PE ratio is needed, right? Now if students we solve this, okay, now if we solve this, it comes as P0 is equal to 6.6 E if you solve all this, right? Because first of all, you will have, what you will have to do is 9, 3, 0.12 E plus E, right? This is what you're going to do. Sorry, not 0.12 plus 1.2. Plus E divided by 3 is what you are going to do, right? Then 3 and this is 2.2 E, so this becomes 6.6 E, right? So P0 is equal to 6.6 E. Simple, we have just calculated the equation here. And hence the P0 divided by E comes as 6.6. So that means the P ratio, this is what students, this is P only, right? This is the price earnings ratio only. This is 6.6 times. Simple. Students, please note PE ratio is a very, very, very important factor while we analyze any company on its earnings and the market perspective. So PE gives a very good analysis because if it is higher, that means the market values that company higher. Because if it is 10 times, if it is 20 times, or if even if it is higher than 20 times, let's say even if it is 50 times, that means it has 50 times the value what it should have been in case it is earning 1 rupee, it would be valued 50 rupees, right? Okay, student. So I hope this is clear. Now let's go to the question number 15 now, students. Now, students, this will revise our one of the again important topics that we studied in the last session. So let's start this. M Limited belongs to a risk class for which the capitalization rate is 10%. That means KE is 10%. It has an outstanding 25,000 shares and the current market price is rupees 100. Okay, this is also given the current market price is 100 and the number of shares are also given. It expects a net profit of 250,000 for the year and the board is considering a dividend of also a 5 rupee per share. And lastly, they are saying that the M Limited also need an investment for rupees 5 lakh for an approved investment expenditure. Illustrate how approach, Modigliani-Miller, which is the irrelevance theory students that we have studied, affects the value of M Limited now. So students, please note, they are asking us to calculate the value of M Limited. That means the valuation of the firm. So what we have studied in Limited, whether you pay dividend, whether you don't pay dividend, whether you pay dividend internally or whether you borrow or so there is no borrowing available or whether you issue new shares and using the proceeds of the new share you pay dividend, in all the cases the value will remain same. Because the assumption net is whatever is the shortfall in the funding that will be funded through the issue of new equity shares and the price will also be adjusted accordingly. That's what we have studied in the approach, right students? Yes, Mancha, you are right. So that's how investor will give the higher P ratio. That means, but the higher the at beyond certain level, Mancha, the highest P ratio would mean that there is a very high risk in the valuation. Because let's say if it is operating at some crazy 80, 90 times, that means there is a clear valuation in the risk. Actual valuation might not be there because, and hence we have to see the fundamentals like what is the balance sheet saying. As per the balance sheet, what is the valuation coming out to be, right? So hence I'm saying that it gives you a direction, but if it is too high, then also it is a very high risky valuation for the company. Okay. Yes, students. So now coming to approach. So this is a question on approach. Simple. Let's just try to put all the information that they have given. First of all, cost of equity. KE is how much? 10%. Number of shares, 25,000. Current market price. So students, it is P0, right? Not P1, it is P0 is 100. Net profits, which is E, is equal to 250,000. Dividend, 5 per share. And the last information, which is investment, I is equal to 5 lakh rupees in totality. So this is what it is required. Now the question is saying that you take out the value in two cases, when the dividends are paid and not paid. So we will take here when dividend are paid. Case 2, when dividend are not paid. This is case number 2. This is case number 1. Jyot is saying NPV remains same. NP 0. Jyot, in which case you are saying NP 0 remains same? P0 remains same. Okay, you're trying to say P0 remains same. P0 in this case. Okay, Jyot, please elaborate your query. Vasu is asking what will be the periods once the growth comes in, once the margins expands, so the P&L will also be turning profitable. That is how the company is looked into. So hence P ratio would not be a right metric in case of a loss-making company, right? Now, when dividend are paid and when dividend are not paid. Now, students, when dividend are paid, buffering. Okay, students, let me wait for a 1 minute again, because as the many of you are saying that the video is buffering, I don't know what is the issue. Let me wait for a moment and then we'll go forward. Hmm. Now fine. Okay. Okay. Thanks a lot, students. And thank you for patiently bearing with us. I don't know what is the issue. Yeah. So, as I was saying, students, that yeah, we'll solve this question. But in case of this negative earnings per share, right? In case there is a company which is making a loss, in that case, what is the P ratio? That is the question asked. Now, what I'm trying to say is that in that case, the P ratio will not give you a right metric, because what is the P ratio? P ratio says that if you earn 1 rupee, what is the multiple at which you can expect the share price to be in the market, right? But in case of a loss making company, still there will be a valuation in the market, correct? It's not that there is no valuation, because there are future prospects, because it is expected that the company will do well in future. There is some growth that for the company is expected to come in future, right? So hence what will happen is that still the other things will be used in analyzing the company's valuation, right? For example, what is the book value? What is the internal value of the company, right? Now let us come back to the question again, students. Now we were discussing about this question in which, first of all, let's say the dividends are paid. So in case the dividends are paid, so P1 is equal to P0, 1 plus KE minus D, right, students? So P1 comes as 100, 1 plus 10 percentage minus, what is the dividend? 5 rupees. So 105 is the valuation. Similarly, here also 100, 1 plus 10 percentage minus 0. So this becomes as 110. Okay, students? Now, the next part, funds requirement. As far as the funds requirement is concerned, what is the total investment? 5 lakhs. Investment. This is case number A, and case number second also, it's 5 lakh. Minus What is the earnings available? Earnings available is 2,50,000 in both the cases. Am I right? 2,50,000. Yes. Okay, students. Plus dividend, what we are going to pay is 5 on 25,000 shares. It becomes 1,25,000 rupees. Here it is nil. So here it is 2,50,000 and here it is 3,75,000. This is the net funds requirement. Okay, students. This is the net funds requirement. I hope till now we have just calculated as per the previous steps. So please, I hope all of you remember we discussed this formula as well. How this formula will be used to calculate the price as per the Modigliani and Miller approach, right, students? Then step 3 was to calculate the number of new shares. So in this case, it will be 3,75,000 divided by 105. And in this case, it will be 2,50,000 divided by 110. Right, students? I hope this is okay. And then lastly, the valuation of the company. This how we are calculating, students. Existing, okay, let me first write the formula so that all of us remember what was it. N plus delta N P1 minus investment plus earnings, right? Whole divided by 1 plus KE for doing the present valuation of the firm, right? Because this is what the present value we have done from 1 plus KE. Mancha is asking, I have a request at the end of the class. Can you please share your insight on recent conversion of Vodafone's debt into equity and impact on the valuation of company? Okay, Mancha, let me see. I don't have the clear facts, Mancha, to be very frank on this, but we will certainly discuss in case you have any query. Okay, Mancha? Now, coming back, students. Valuation of the firm in the first case, in the case number 1, is how much? 25,000 plus. Delta N is how much? 375 divided by 105. This whole multiplied by 105 minus investment is 5 lakh and earnings is 2,50,000 whole divided by 1 plus 10 percentage. Okay, this is case number 1. Case number 2. What is case number 2? So 25,000 remains same plus number of new shares 2,50,000 divided by 110 multiplied by 110 minus 5 lakhs plus 2,50,000 whole divided by 1 plus 10 percentage. Okay, students. So case number 1 and case number 2, if we solve this, so the value comes out as 25 lakhs. And in this case also it is 25 lakhs. So in both the cases, now this as per the approach, in both the cases, the amount or the value of the firm comes out to be same. Soumya is saying, please work out practical question 5 and 6 in chapter 8 also. Chapter 8 is, I think, for the dividend decisions. Sorry, this risk analysis. No? Just a second. Let me check the study material. I hope you're asking from the study material. Soumya? Okay, Charu is asking, why do we calculate the funds requirement? See, Charu, funds requirement, why do you calculate? Because there is an inherent assumption. Okay, let me put here, why calculate funds requirement? Because approach says that there is no borrowing. Okay, and there is definitely some investment required after the year end, and you will earn also something. So investment is outflow, or let's say investment earnings will be an inflow. And similarly, if you also plan to give any dividend, that is also treated as an outflow, right? Net net, whatever it is, plus or minus, mostly it would be minus only. Hence, for that equivalent amount, we will raise the new funding, new issue of equity. Study material 8A, risk analysis in capital budgeting. So in this, Soumya, okay, we'll come to that, Soumya. Okay, I'll park your query as of now, and we'll come to that. Yes, yes, Soumya, we'll come to that. Anyways, one question is due today also in that, so we will cover that question today. Okay, let's move forward now. Let us come to question number 16, students. So question number 16. The following information is supplied to you. The total earnings is 2 lakhs. Number of equity shares is 20,000. Dividend paid is 1,50,000. Out of 2 lakh, we have paid a dividend of 1,50,000. And the PE ratio is given as 12.5. Okay. Now, applying Walter's model, analyze whether the company is following an optimal dividend policy or not. Simple. So students, now in this, you are not given R and you are also not given KE. But definitely you have been given with the proper things to calculate both R and KE. Right? How we can calculate the EPS. What is the EPS first of all, students? 2 lakh divided by 20,000. That means 10 rupees per share is the EPS. And what is the face value of the share, or let's say the book value per share? Because in this, there is no data on reserves and surplus. So hence we can say that R is equal to 10 divided by 100 because the face value is 100. That means R is equal to 10% is what we have just studied some time back, and the same thing we are applying here. Right, students? And for calculating the KE, can we say that 1 by PE ratio is KE, which is equal to 1 by 12.5, which is nothing but 8%. 1 divided by 12.5 into 100, which is 8%. Right, students? So from this, we can calculate that R is 10% and KE is equal to 8%. Very simple till now. Can we now apply the Walters formula? No, sorry. What is the question asking is applying Walters formula. First of all, you analyze whether the company is following an optimal dividend policy. Now, what if R is greater than KE? What is the optimal dividend policy? Zero. Dividend payout should be zero because to maximize the wealth, the money has to be invested again back in the business rather than giving it to the other shareholders, right? Right, students. So the dividend payout ratio is zero in this case. So hence the company is not following the optimum dividend policy, right? Because the currently the company is giving 75% as dividend. However, as per Walters model, since R 10% is greater than KE of 8%, the dividend payout should be zero, or we can say it should be avoided, right? In case it is zero, then what is the price? Okay, is the question asking us to calculate the price? Just a second. Let's see first. No. Now the second part, compute the PE ratio at which the dividend policy will have no effect on the value of the share. Now students, this point is very critical. Now they are saying that compute a PE ratio at which the dividend policy will have no effect. That means whatever dividend you pay, it will not impact the value of the share at all. What is the situation that we have studied till now, students, in which this kind of thing happens? This kind of thing happens when your R is equal to KE. Then only, this is the only case where if you pay any dividend, it will have no impact on the prices. Right, students? So hence, in the second case, what we can say is PE ratio, we are calculating. In this case, the KE is equal to R is equal to 10% because R is what? 10%, right? And hence the PE ratio is equal to 1 divided by 10%, which is equal to 10 times. When KE is equal to R, the dividend policy would not have any impact on the share prices. Hence, the resulting PE ratio is equal to 10 times. Not 10%, 10 times. Okay, students. I hope this is clear. Now, the last part of the question. The last part of the question says, will your decision change if the PE ratio is 8 instead of 12.5? Analyze. Yes, because they are saying that In the first part, they have asked our decision whether the company is following an optimal dividend policy or not. We have said no, the company is not following. But they are saying now if the PE ratio is 8, then will your decision change? In case the PE ratio is actually 8, the KE will be 1 divided by PE ratio, which is equal to 1 divided by 8, which is equal to 12.5 percentage. Correct? So that means the KE becomes 12.5 percentage. And in such a case, KE is greater than R, that is 12.5 percentage is greater than 10%. Earlier it was 10, right? So definitely higher dividend is expected. That means the dividend payout should be higher in such a case. Right, students? I hope you're able to get my point. Now, since KE is higher than R, the dividend payout ratio should be 100% in such a case. Right, students? Vrinda is saying, please show the first part note. This is the first part, and this is a note of it, Vrinda. So students, in this, apart from this also, we can calculate the share price as well in the different scenarios that are given. For example, in the first part, what is the share price? Second part, what is the share price? And third part, what is the share price? In the first part also, after our recommendation, what is the revised share price that comes out to be? Okay. Then this was the second part, students. And this is the last part. Students, now let us go to the next question. Question number 17. With the help of the following figures, calculate the market price of a share of a company by using Walter's formula and dividend growth model, which is the Gordon's formula. Both the formulas they are asking us to apply. Okay, students? Now let us first try to put the numbers. EPS is given as 10, DPS is also given, cost of equity, internal rate of return, which is R percentage, and the retention ratio, which is B as 40%. Now, Walter formula. This is just a formula based question. All the information is given. This is straight away formulas application. Price is equal to D plus earnings minus dividend multiplied by R divided by KE whole divided by KE. Right? Now let us put the numbers here. P is equal to 6 is the dividend payout ratio, right? Because 40% multiplied by earnings is 10. So 4 is the retention. That means 6 is the dividend. If 4 we are retaining, 6 is what the dividend is. Right, students? So 6 plus 10 minus 6 multiplied by R is what? 25% divided by 20%. Whole divided by 20%. The value comes as price of 55 per share. Simple. Just we have applied the formula, calculated the numbers. That's all. Now, dividend growth model, Gordon's formula. What is the Gordon's formula? In case of a dividend growth model. So we have to use that B and R principle again, right? The same thing that we have discussed earlier. So the formula is P is equal to E1, 1 plus 1 minus B, sorry. Which is nothing but it converts this into the dividend, right? As we discussed yesterday, divided by KE minus B into R. So hence the price will be equal to 10 is the earnings, 1 minus 0.40. So that means B is equal to 0.40. That is given in the question. KE is this much. 0.40 multiplied by R is equal to 0.25. Simple. So 6 divided by 0.1, which is equal to rupees 60 per share. So as per the Gordon's formula, P is equal to 60 per share. That comes out to 60 rupees per share. I hope students this is clear, right? Yes, students. Now let us come to next question. Question number 18. The annual report of XYZ Limited provides the following information for the financial year 2021. Net profit, outstanding 15% preference shares, numbers of equity shares, R and KE. Calculate the price per share using the Gordon's model. When the dividend payout, they have given us the different dividend payout ratios. So in this case, if B, 1 minus B is what the dividend payout ratio is, right? Which is actually 0.25, 0.50, 1.00. In this case, it will be 0.75, 0.5 and 0. Correct, students? So we have calculated the value of B as well as 1 minus B both. Now we have to apply the Gordon's formula. Applying Gordon's formula. Now this formula we are going to apply since we can calculate the EPS from above. So earnings 1 minus retention divided by 1 plus, sorry, not 1 plus, KE minus B into R. This is the formula to calculate the price. Now, for the first case, case number 1, when dividend payout is 25%. In such a case, okay, we have to calculate, students, the earnings also first. Okay, so let me do one thing. Let me put here the calculation of earnings per share, right? What is the net profit? So students, the net profit is 50 lakhs less preference dividend. So preference dividend is how much? Again, 15 lakhs, right? So 15% multiplied by 100 lakhs. I hope these are the numbers. Yes. So Mancha is asking, sir, as per Gordon, even is mentioned in the formula. It means EPS growth rate. No, Mancha. See, even means EPS at the end of the year. This is what EPS means. Because, Mancha, you would remember we have done the Gordon formulas in two ways. One is either use even 1 minus B, right? Or use D0 1 plus BR, which is nothing but the growth rate, right? 1 plus G. This is the second formula that we have studied. Shall I go back and show you? Just a second. See, Mancha, this one. You remember? D0, 1 plus D. So this is what is E1 means, that earnings per share after 1 year. D0 means dividend of today or dividend that we have already paid. In that, we are going to do 1 plus G. So that will make the dividend for the year end. Okay. Less preference dividend. So it becomes 35 lakhs divided by number of shares. Yes, Tanu, you're right. Tanu and Rohan, EPS is 7 per share. That is right. So this we will divide it by the, 5 lakhs shares. So 7 per share is the earnings per share. Okay, students. So earnings per share is 7 per share. Now, coming back here. When dividend payout is 25%. So what is the formula? 7, which is the earnings per share, 0.25 divided by cost of equity 0.16 minus. What is B in this case? We have seen if dividend payout is 0.25, B is 0.75. So 0.75 multiplied by the R. R is how much? 0.20. We solve this, it becomes 1.75 in the numerator, and in the denominator, this is 1%. If we divide, it becomes 175. Yes. Case 2. When dividend payout is 50%, 7 multiplied by 0.50 divided by 0.16 minus 0.50 multiplied by 0.20, right? 3.5 divided by 0.16 minus 0.10. So 3.5 divided by 6%, it is 58.33 rupees. Thanks, Mancha. Okay, now last part, case number third. When dividend payout is actually 100%, right? This is the third part? Yes. In this case, what we know is that B is equal to 0, right? So 7 into 1, right? Or we can say 1 minus 0, so it will be 1 divided by 0.16 minus 0.20 multiplied by 0. Right, students? So this is essentially 7 divided by 16%. So this becomes 43.75. So in all the three cases, we have calculated the price using the Gordon's formula. Very easy, very simple. Okay, students. Now let us move forward to the next question. Question number 19. Very interesting and very good question. So let us do this question. And something what we have not seen till now. Okay. A&R Limited is a large cap. What is a large cap? Large capitalization, which is a large capitalization. That means it has a large market cap. Market cap means market capitalization, which is nothing but the number of shares multiplied by market price per share. Anyway, this is not what we have to see. Yeah, very good, Gajar. Your answers are right for the previous question. Yes, so what I'm trying to explain is the meaning of this word large cap. That means they have very large number of shares and they have very high market price per share, and hence they come into large cap, not mid cap, small cap, because there are different segments, there are different caps. Okay, so this is a large cap multinational company listed in BSE, Bombay Stock Exchange, in India with a face value of rupees 100 per share. Okay, so they are listed, but they have given us the face value of 100 per share. The company is expected to grow at 15% per annum for the next 4 years. For the next 4 years, the company will grow at 15% and then 5% for an indefinite period. So that means for the next 4 years, so if we are at Y0, Y1, Y2, Y3, Y4. So these 4 years, the growth will happen at the rate of 15% per annum. After this, the growth will happen at the rate of 5% per annum. The shareholders expect a 20% return on their share investments. Now, what they are saying is that they need at least a 20% return. That means the KE is equal to 20%. Company paid 120 as dividend per share for the financial year 2021. So dividend per share that is already paid is 120 for FY 2021. The shares of the company traded at an average price of 3122 on last day. So they have given us the trading price also. So students, you see, the face value is what? 100. The market price is what? 3122. Can you see the difference? Now, let me jump to one new topic from this, which anyways was part of my discussion today. I am holding the question here and I'm coming to a new topic. The face value is 100. The market price is in the range of, let's say, 3200. Now, what is happening? The market price, since it is at 3200 levels, it becomes really problematic for the investors, for the retail investors, to invest in even one share of this company. Why? Because the valuation of one share is also very high. Hence, it cannot attract a lot of investors because of that. Because we will feel that, okay, 32 rupees only one share. Although I can tell you, students, if the appreciation or a depreciation in this will happen, that will happen in, let's say, 10s, 20s, 50s, right? Or if you invest a share of rupees only 10, so I'm talking about this as a change here, right? So change will happen, let's say 10 rupees will increase or decrease, 20 rupees will increase or decrease, 50 rupees will increase or decrease. But on a share of rupees 10, only 0.1, 0.2, 0.3 will change, right? So the percentage will always be same. The percentage change will always be same. If 1.1 percentage it has increased, similarly we can also say that more or less 1.1 percentage will increase. But since the value of the share is less, the absolute value of change will also be lesser. But the market understands only one thing, that if higher the share price, it sometimes becomes a roadblock for the investor to invest, even for one share. So what companies do? Companies do a practice called split stock. Simple. They will do a, yes, right, Gajar. Gajar has already mentioned, and company decided to split the shares. That is what. So here the splitting will happen. Now, what is splitting? Splitting is, let's say you have 10,000 shares at the rate of 3200. How much it becomes? 10,000 multiplied by 3200. It is around 3 crore 20 lakhs. Right? This is the market cap. Now, what will happen in splitting? In splitting, the company will say, now, instead of 10,000, I will split one share into 100 shares. So one share gets splitted into 100 shares. That means instead of 10,000 shares, now the company's revised count will be 10 lakh shares. And the value per share, or the price per share will be now 32 rupees instead of 3200. Now, what I'm trying to say, that the revised market cap will still be same. 32 into 10 lakh is 3 crore 20 lakhs. Still going to be the same. So what is the use of stock split? The use of stock split is to reduce the per unit valuation of the shares, because the number of shares are increased. That is the reason. Okay. So this is again one of the topics that was there. Now Gajar is asking, sir, but as today TCS share face value is 1, market price is around 4,000. So what company decided? So Gajar, again, it depends on what the board of directors want. What is their objective, right? Now, if 4,000, they still feel that it is okay to go, and what are the competitive shares? What are the competitive company shares? So they can go ahead with the same. But I mean, it is purely dependent on what they want to do, right? I've just taken an example. Might be 3,200 rupees would not be a right price per share to do a share split. But what I'm trying to say is that if the prices becomes very high, right, then definitely that one unit of a share becomes unaffordable to that particular investor. Although students, there are other ways and means which are actually part of our CA final. For example, still if you don't want to, if you can't invest 3,200 rupees in one share, you can opt for futures and options. Still you can deal in a share of 3,000, 4,000, 10,000 without investing actually that money into that share. I'm not touching upon that topic that we will cover in the CA final part, right? So, but this split stock as a concept came because to reduce the per unit valuation and to increase the number of shares so that to make the overall valuation as same. Now coming back here, students, coming back to the question. Now what the ask is to find out the intrinsic value per share and state whether the shares are overpriced or underpriced. Now students, before we go into the calculations, we know that there are different ways of doing the valuation of the shares. One is the market price. Intrinsic value is another one, right? Intrinsic value is what? This is actually dependent on the future cash flows and after discounting, right? This is one, this is second, this is third. Third is what? Book value per share. Simple. Assets minus liability divided by the number of shares. This is also one of the method. Okay, students. So when we say now students, if you see that what is the intrinsic value is purely dependent on the future cash flows, right? Now if the future cash flows says that the intrinsic value per share is, let's say, 100 rupees, but the market price per share is of that share is only 100, don't you think it is overpriced? And in case 2, the share trading is happening at 80 rupees. However, the real worth, the intrinsic value is only 100. So don't you think the people have priced it lower? So can we say that it is a underpriced? I'm putting it properly. This is overpriced. This is underpriced. Right, students? Don't you think this is the overpriced and unpriced thing? Sandeep is asking what's the 3 point? Uh, third point is book value per share. This is assets minus liabilities divided by number of shares. Right, students? So this is the concept of overpriced or underpriced in MPS compared to the intrinsic value. Now, this is the context of the question. Now, students, what I suggest is let's break for 10 minutes, then we will quickly solve this question. The conceptually question is over for us. We have to just apply the formulas and solve the question. That's all. Okay. So we will again connect back at 7:32. Live. Yeah. So welcome back, students. We were discussing about the question number 19, right? Now, there are two, three queries before we move forward. Vrinda is saying, please repeat. Okay, Vrinda, which point you want me to repeat? See, what we discussed is, okay, while doing this question, we will again go back to the what we discussed and we will finally conclude it. Okay. Vasu is saying, what is intrinsic value? Okay, so Vasu, intrinsic value is, see, there are two things. One is in the market, whatever is the value going on that we call as market price per share, because that is the trade at which, that is the price at which the trade in the market happens, right? But while we see what is the intrinsic value, now intrinsic value is basically governed by the fundamentals of the company. Now there are two things, right? Fundamentals and technical. Fundamentals means how does the future cash flows look like? How is the current balance sheet holding the entire capital structure, or what is the valuation basis? The intrinsic means something internal, right? Something internal valuation. So that is basically in this question, the intrinsic value they are referring to the value that has to be calculated using the dividend discount model, which we are going to calculate now. Correct. So just to start with the question, so here we put the dividend, right? FY 2021, 21, 22, 22, 23, 23, 24, 24, 25, and 25, 26, right? So this they have given as 120 already, right? FY 2021 is 120 already. Now we have to value here, right? After 2021, what is the valuation? That means before 21, 22. So this is our year beginning, right? So here it will be 120 multiplied by 1.15. 120 multiplied by 1.15 into 2 raised to the power of 2. 120 into 1.15 raised to the power 3, right? Similarly, here it is 120 into 1.15 raised to the power 4. And here it will be, the last part is 120 into 1.15 raised to the power 4 multiplied by 1.05. So what was the question saying? Just a second. The question was saying that the company is expected to grow at the rate of 15% per annum for the next 4 years and then 5% for an indefinite period, right? So if we solve this, students, then ideally this should also be 1.15. Let us see once. Let us calculate this. 120 into 1.15. So the first value is 138. Then 138 into 1.15, if I again do, it is 158.7, right? Into 1.15, if I do, it becomes 182.505. Then 1.15, if I again multiply, it comes as 209.88. So 4 years, it has grown at the rate of 15%, and then it will grow at the rate of 5%, right? So it becomes as 209.120 into 1.15, 1.05, 220.37, right, students? Now, to calculate the price, what we have to do is just take these numbers and do the discounting. Now, the discounting will happen at what rate? The KE is at 20%, right? Yeah. The shareholders expects a 20% return, right? So the KE is 20%. So first of all, it will be 138 divided by 1.20, right? Plus 158.7 divided by 1.20 raised to the power 2 plus 182.505 divided by 1.20 raised to the power 3, correct? For the third year. Then similarly for the fourth year, it is 209.88 divided by 1.20 raised to the power 4. And then for terminal value, right? Terminal value, it will be 220.37 divided by 20% minus what is the indefinite growth? 5%, right? And this whole, we will have to take it as 1.20 raised to the power 5. Right, students? Sorry. Yes, Vrinda, we are doing this only. So this comes as 115 plus 1110.2 plus 105.6 plus 101.2 plus the last part will be 220.37 divided by 15%. 590.42. Right, students? To solve this, take a total. So this comes as P is equal to 1022.42. This is the price. Right, students? So this is as per the dividend discount model. I hope this part is clear to all of you. So it's nothing like in what we do in capital, what we have done in capital budgeting. We calculate the monthly cash flows that we have done, and then for terminal value, we calculate the what is the present value of the indefinite cash flows. So that we take as discounting rate minus growth rate, right? And in this we take 220.37, right? So that will give us the terminal value at the end of year 5, and using that we will calculate our overall amounts. Let us go to question number 20th. Okay, there are some good queries. Now let me take them one by one. So Ria Goel is asking, sir, in certainty equivalent approach in the risk management, we are moving risk and also using risk-free rate, means twice excluding the risk factor. Sir, please explain this thing in detailed manner. Okay, Ria, I will park this point. We will do the discussion on this when we will discuss the risk analysis factor. Okay. Vrinda is saying, please repeat this sum from start because video was buffering earlier. Okay, Vrinda, let me do that. I will repeat the previous sum again. Shivam is asking how to calculate it by calculator. Simple, Shivam. We can just take the numerator divided by 15% and then keep on dividing. For let's say there is a division. Let's say there is a division here of 1.2 raised to the power 5, right? So we can divide 5 times by 1.2, the same sum. Okay. For example, 220.37 divided by 20% minus 15%. So we can simply do divided by 15%, right? Simply divided by 15% if we do using the calculator, and then keep on dividing it by 1.2 one time, then again 1.2 two times, again divide three times, again divide by 1.2 four times, and again divide by 1.2. Then comes 590.42. This is the number. I don't know whether it is visible or not. But using calculator, we can just simply do the steps that we could have done it manually. No, Charu, the question is not actually confusing, but the question is actually on the dividend discount model, and it says that you have to calculate the estimates first and then do the discounting. Only one part is left in this, which I have left, which we will do now. Mansha is asking why there is a need to multiply by 1 divided by 1.2 ratio, because already it is a present value. Okay, so Mansha is saying this is already a present value. Why are we again multiplying it by 1.2 raised to the power 5? Dividing it by 1.2 ratio. See, the thing is that this is a present value after the end of 5th year, Mansha. Okay, this is the present value, not as on today, not as on y0. This is as on y5. Hence, to bring it to again y0, we have to do one more present value. Hence, we have taken 1.2. Okay, Mansha. The same thing you would have done in the capital budgeting also for the terminal valuation, because first you do the terminal value, present value at the end of the life, which is year 5, not life, but the till the time where you have a different growth, and then you do another present value to make it to 0. Now Gajar is asking market price is overpriced by 3122. Yes, that is right. So that is the point which I also left here. So the price intrinsic value is coming out to 1022. So actually the internal value basis the calculation should be 1022, but the market price is actually 31, how much? 3122, right? Yeah. So hence market price is overpriced, simple. Because it is trading at a higher value than it should have been. Okay, students? Now let us come to the question number 20. So question number 20. In May 2020, shares of RT Limited was sold for 1460 per share. A long-term earnings growth rate of 7.5% is anticipated. That means G is equal to 7.5%. They are saying it is a growth rate of 7.5%, right? R Limited is expected to pay a dividend of rupees 20 per share. Calculate the rate of return of an investor can expect to earn, assuming that the dividends are expected to grow along with the earnings at 7.5% year in perpetuity. So students, it is asking us to calculate the R, not R, sorry, KE. It is asking us to calculate the KE. Right, students? It is asking us to calculate the KE. Now, students, we know that P0 is equal to D1 divided by KE minus G. This is the formula that we already know, right? This is a relationship as per the Gordon's model that we know. Can we put all the numbers here? 1460 is the price. D1 is what? 20 is the current dividend. So what we know here is D0 1 plus growth, right? This was the exact formula. D0 1 plus growth, multiplying that. So 1 plus growth is how much? 7.5%, right? Divided by KE is what we have to calculate, because that is what is the requirement of the question, and G is 7.5%. Okay, so if we solve this, KE becomes 8.97. This is the first part of the question. Second part, it is expected that RT Limited will earn about 10% on the retained earnings. That means R is 10% and shall retain 60% of the earnings. So B is equal to 60%, R is equal to 10%. In this case, state whether there would be any change in the growth rate and cost of equity. Now, students, please note, they are first of all asking us that is there any change in the growth rate and cost of equity. Now, here there are two important things. First of all, we have to calculate that what is the change in the growth rate and then cost of equity. Now, students, for cost of equity, we could have taken the same price, but if there is a separate, now all I request all of you students to please pay attention here. Now, we know that the current dividend is how much? 20, right? But what if we change some of the conditions? Now, what are those conditions? The first condition is R they have given us, but the payout ratio they are changing, sorry, the retention ratio they are changing to 60%, right? We don't know what was the earlier retention ratio, right? We don't know what was the earlier retention ratio, hence, but definitely they have changed the retention ratio to 60%. So if the retention ratio is changed to 60%, then how much dividend would have changed? That we have to compute, correct? Right, students? So that we have to compute. Now, to compute that, first of all, we can say that growth is equal to B into R. So growth is equal to 60% multiplied by 0.10, which is 6%. So the revised growth rate is 6%. Correct? What was the earlier growth rate? Seven and a half percent. So if the earlier growth rate is 7.5%, revised growth rate is 6%, they're asking us to calculate the revised cost of equity. Revised KE, right? That we can simply calculate. P0 is equal to D0, 1 plus growth rate divided by KE minus G. This is the formula. In this, we have to calculate the KE, rest all things are given. But there is a very big mistake, students, we will do if we put growth rate directly as 7.5% and take the dividend also as 20. This is wrong. Why? Because the question explicitly saying to you that they have changed the retention ratio. Now, the moment they do it, we cannot assume that dividend in second part will also be 20. This is a wrong assumption. So we have to calculate what is the revised dividend. To calculate the revised dividend, we need to know that what is the existing earnings per share. To calculate the existing earnings per share, we need to know what is the existing dividend and existing retention ratio. Right, students? Now, this existing dividend, we know it is already 20. Now, this existing retention ratio can be calculated. Yes. Again, we will use the formula, this 7.5% is the existing growth. B is what we have to calculate, and R is already given as 10% in the question. I hope, students, this point is clear. Now, using this, we have calculated that the existing ratio is 75%. 7.5 divided by 10% becomes 75%. So the existing retention ratio is 75%. That means the existing dividend payout ratio is how much? Is 25%. So the EPS is how much? 20 divided by 25%. That means 80 rupees per share is the EPS. Right, students? So the 80 rupees per share, if it is the EPS, then the revised DPS is how much? 80 multiplied by 60. Sorry, 80 multiplied by 40%. Because 60 is the retention ratio, right? So 1 minus this. So the revised DPS is 32 rupees. I hope students this part is clear to all of you. Now with this DPS, we will again put the numbers here in this formula and calculate the KE. So 1460 will not change. 32 1 plus 6 percentage divided by KE minus 6 percentage. This is what we have to calculate, and hence the KE will be 8.19 percentage. Very easy and very simple, students. See, there is the reason behind picking this question was very simple, students, is we need to know that if the question says that they have changed the retention ratio, that means we cannot assume the same dividend that we were paying last time, because the earlier dividend was based on some other retention ratio, which was 75%. Now the revised retention ratio is 60%. So hence, using that, we have to calculate our revised answer, right? So this question is also complete, students. Let me go to the previous question because there is a query from Brinda to repeat that question. Okay. Now I am at question number 19. So just I'm repeating this question. Now this question is very properly framed in such a manner that it is asking you to calculate just the intrinsic value. Okay. And now what is that intrinsic value based upon? You have to just see what are the dividend payouts year on year, which is year 1, year 2, year 4, like this, and take a intrinsic value. That means you have to take a present value of all this, like present value of all this. Now the present valuation will also happen at a cost of equity using as a discount rate. Now they are saying that for doing the present value, for doing the cash flows first, you have to assume two different rates. One is 15% for the first 4 years, the growth, and the next indefinite period is 5% per annum. Now, students, please note that for the first 4 years, we have calculated our cash flow like this, right? Simple. We have taken the current existing dividend and we have calculated the numbers. But the terminal value, for the purpose of terminal value, we are using this, right? This is again borrowed the same principle from our capital budgeting concepts. And the same thing I have repeated in the previous session on the Gordon's formula as well. And simply using this concept, we can calculate our intrinsic value. Now, what I was trying to say here is that there are different kinds of valuation of a share. One is the market price, which is totally market dependent. Second is the intrinsic value. In this portion, the intrinsic value is dependent on the future cash flows. There can be third type also, which is book value per share, which is nothing but all the assets minus liabilities divided by the number of shares. So what overpricing or underpricing means is, overpricing is always comparing the market price, right? What is the market price, first of all, compared to the intrinsic value. Now, what is intrinsic value? Intrinsic value means the value calculated internally. This is the fundamentals. For example, the cash flows, the balance sheet and all. Now, that will tell you the real worth, because what can happen in market? In market, the things might trade in discount or in premium depending on the purchase and sale, or let's say that depending on the investor's speculation, right? But what company gives you the right valuation is basis the intrinsic value, what is behind the company, right? So hence we have said that if market price is higher than the intrinsic value, hence it is overpriced, because the real worth is 100 rupees but it is getting traded at 120. Similarly, it is getting traded at 80 but the real worth is 100. That means it is definitely underpriced. Okay. Yes, Gajar and Sandeep. Okay, Vrinda, I hope you're asking about this. Now, the question number 20th second part. Khushi is asking again question number 20th second part. Okay, Khushi, let me repeat that. Now, I think the first part was pretty clear. You forget everything. Just remember one thing. This is a simple formula based question. Okay. The first part I'm saying. And what is the formula? Gordon's model. Gordon's model, there are how many variables? 1, 2, 3, 4. There are total 4 variables: price, dividend, growth, and cost of equity. Out of 4 is, if anyone is missing, you can find that. In this case, they are asking us to find KE, rest all they have given. But what if they change some of the conditions? Now, what is the condition that they have changed? Now, please note that this D0 is a dividend which is derived how? So dividend is what? EPS multiplied by 1 minus B, 1 minus retention ratio, correct? Now, if you're changing this retention ratio, don't you think it will have impact on D? So that is what we have tried to calculate here. We said that 20 is not right to assume because the right dividend should be 32. The value will remain same. There is no change in the value. The value will remain same. But this 32 rupees will have an impact. So basis that we have calculated the revised KE here. Okay, Kushi. Now let's go to the last question of dividend. Question number 21. Now what it says. Akash Limited has 10 lakh equity shares outstanding at the start of the accounting year 2021. The existing market price is 150 and the expected dividend is 8 per share. That also they have given. The rate of capitalization appropriate to the risk class to which the company belongs is 10%, which is nothing but the KE. Calculate the market price per share, right? When the dividends are declared, or second part is not declared based on the approach. Then the second part they are asking, calculate the number of shares to be issued by the company at the end of the accounting year on the assumption that the net income for the year is 3 crore and the investment budget is 6 crore when dividends are declared and when dividends are not declared. Simple. Then the last step, proof that the market value of the shares at the end will remain unchanged, irrespective whether dividends are declared or not. So they're asking us to adopt the entire approach, step 1, step 2, and step 3. That's all in the question. We can easily calculate. Again, we'll put case 1, case 2. Case 1, dividends are declared. Not declared. So the price is calculated how? P0, 1 plus KE minus dividend, right? So what is the current price? 150. 1 plus 10% minus. In the first case, we are paying the dividend is 8 rupees. Is 157. In the second case, when the dividend are not declared, 150, 1 plus 10% minus 0, which will be 165 students, right? I hope this is okay till now. Now, the first part is done because in the first part, they have just asked us to calculate the market price per share using the approach that we have calculated. Now, the second part, calculate the number of shares to be issued by the companies. So the second part is number of shares to be issued by the company. First of all, what is the investment required, students? See, again, now we are calculating the funds requirement. Before we want to calculate the number of shares, we have to calculate the funds requirement. 6 crore, 6 crore minus earnings, 3 crore, 3 crore plus dividend. In the case 1, since dividends are declared, dividends will be declared at 8 per share for 10 lakhs. So 80 lakhs, 0.8 crore and nil. Right, friends? This is how much? 3.8 crores. This is how much? 3 crores. This is the investment required, right, friends? Number of shares. 3.8 crore divided by what is the price in the first case? 157. 3 crore divided by 165. These are the number of share, students, right? This is okay. And the last part of the question says, the third part, calculate the proof that the market value will be same, right? So now we will prove. For that, we will calculate the value of the firm. This is the third part. That will be calculated how? N plus delta N P1 minus I plus P divided by 1 plus KE. Right? That's how we are going to do. So in this case, what is the N? 10 lakhs plus 3.8 crore divided by 157 multiplied by 157 minus 6 crore plus 3 crore whole divided by 1 plus 10 percentage. Similarly, in the second case, students, in the second case, this 10 lakhs plus 3 crore divided by 165 multiplied by 165 minus 6 crore plus 3 crore whole divided by 1 plus 10 percentage. Now, students, please note that since the question is not asking us to calculate the market value as in today, we can even ignore this as well. Right, students? We can even ignore that divide by 1 plus 10 because in this case, what we are doing is we are calculating the today's market value from the future market value. Correct? So we will solve ignoring this only. So it comes as 1950 lakhs. And the second case also it comes as 1950 lakhs. And also, students, one more thing. Actually, it is not 1950. It will come as 1947. And this one also is 1947. Right? So, this comes as 1947. However, the question is actually framed in such a manner that they're asking us the market value. Right? Market value of the shares. So, the market value of the shares is computed how? Only this value is the market value, right? In both the equation, if you see, only this value is the market value, which is actually 1955. 1950, sorry. This one is also 1950. This one is also 1950. Okay, students? Yes, Vidya, you are right. 1950 lakhs. So in the the market value is this much. So students, with this, the dividend decisions from my end is actually over. The discussion on dividend decisions from my end is actually over. Now let us actually go back to some of the things from the risk management, risk analysis. So students, first of all, in this, our one of the last question was pending to be done, right? So we will solve this question and then I will take some of the queries. Yes, Gidjar, all the questions of module done. That's right. Now let us come back to the dividend. Sorry, not dividend, risk analysis. The last question. So students, before we do that, let me just first take a quick cap on the risk analysis again, right? Let us do the revision and in the last we will take that topic, right? And in between I will take one query from Ria Goel for the certainty equivalent approach. And there was one more query on solving question number 5 and 6, right? From just a second. Question raised by Charu. You also mentioned you have a doubt in module illustration number 7. We have covered that illustration number 7 in the class, Charu. Now let me know if you still have a doubt. Okay. Yeah, Soumya had said 5 and 6 question number as well. And Ria Goel query on certainty equivalent approach. Okay, these two things I will take it up along with the last question in this part. So students, first of all, what we discussed on the risk analysis, right? We said risk analysis and capital budgeting. Capital budgeting, we already knew that it involves cash inflows and cash outflows. What is risk? For understanding risk, we understood 3 types of situation. One is 100% certainty, second is risk, and third is uncertainty. 100% certainty can be in the form of the legal agreement, because there is a legal agreement, hence we know that this cash flow is bound to happen. But risk comes in a situation where you don't know that what is going to happen. You can only estimate the cash flows along with some probabilities. And uncertainty means you are totally not knowing. You cannot even calculate the cash flows nor even the probabilities, because let's say you're dealing in a new product. Now we studied that what is the meaning of possible outcomes, right? And we discussed what do we actually mean by probabilities. Let me come to the probability. Probability, we know that it is always 0 to 1 and it is a chance of an event occurring in future. Now using probability, we started calculating the expected value, the expected net cash flow and the expected net present value. That was again an easier part. Then we said that what is a standard deviation is equal to risk, right? Because risk is a deviation of the possible outcomes from the expected outcome. And that is what the deviation we were calculating in the standard deviation, right? Because the deviation itself is the name within of the standard deviation. We are doing a square and then we are doing a under root, multiplying of the probability. Then we said that this chain was complete. Using probability, we can calculate variance, standard variance, and the coefficient of variance. Then we said that what are the techniques for the risk analysis and capital budgeting. The first technique that we studied is the risk adjusted discount rate. Now in this we said that we will adjust the risk itself from the discount rate. While we said that how to adjust the risk, after risk adjustment the discount rate will go up, right? Because higher the risk, higher the discount, higher the interest rate, and hence the higher discount rate, right, students? And then the second part we discussed in the certainty equivalent approach. Now, in this case, we said that the certainty equivalent approach, we will use the certain cash flows, the guaranteed cash flows, right, to evaluate a project. And while using that, we will use the specific, yeah, this was the table that we studied, right? So while we use risky cash flows, we will use the risk adjusted rate. While we will use the guaranteed cash flow, we will use the risk free rate. Now here is the question from Ria. She's asking that in CE approach, we are removing the risk and also using the risk free rate. Means we are twice excluding the risk factor. That's okay. Now let me explain this. Yeah. Let us explain it through the false part. What if we use the guaranteed cash flow and the risk adjusted rate? That is the second and the fourth part. In that case, what will happen? You are using the risk element in the present valuation. See, what will happen? Okay, let me take an example. For example, the risky cash flow is 100, guaranteed cash flow is 80, risk-free rate is 7%, and the risk adjustment rate is 9%. I hope this is clear. Now, what will happen, Ria, in that case, the NPV will be calculated how? I am telling you to take 80 and 7. What if you take 80 and 9, the NPV will become 2 times lesser. How? One is that 100 minus 80, already 20 will get reduced in the NPV. But if you're discounting through a higher rate of 9%, again the NPV will be further reduced by this 2% higher rate. I hope you're getting my point. So there will be twice the adjustments in the NPV if you take the lesser discount, lesser guaranteed cash flow and the higher discount rate. To adjust the NPV properly, we will have to take a lesser rate, because if you take the lesser risk-free rate, your NPV will stand corrected to that extent. Correct, Ria? I hope I'm able to make your point clear. Charu, I am not sure whether this will be uploaded with solutions, my handwritten notes. What I suggest is, please, to all the students, all of you, that you also please make your own notes, because that will help you in your revision. Because ultimately in the examination, you will not be able to do everything by hand, specifically in this type of a paper, right? So what I suggest is that definitely you prepare one set of notes which are easily revisable in your own format. Obviously take the inference from these notes, right? Because if you make notes in your own form, it will help you. It will help you in all the revisions. And also, students, one more point I want to share. Let's say you have 100 questions. Now, before examination, you cannot revise all the 100 questions. So what are you going to do? So make it a habit that all in 100 questions, you will, while in the first and the second revision, it is expected to revise all the questions by hand practice. But in those 100 questions, you will definitely identify at least 10 to 20 questions where you are stuck in, right? Where you are not able to go through the proper solution. So those you mark to be revised mandatorily in your examination days. Another 20 to 30 you will be able to solve, but you will be able, there is a specific conceptual point or there is a keynote in that question. So always put that keynote separately, that this is the keynote in this particular question. In case this is the assumption that this has to be followed, in case this set of information is given, then we have to follow like this. Okay, students. So hence I'm saying this is the right, and then the balance questions would be very conceptual and would be very basic, which even if you don't revise, but if you go through at a glance, if you don't practice it at the time of examination days and you go through at a glance, you would be in a comfortable position. So I'm saying to bifurcate all the questions into 3 buckets. One, the ones that you have to do by hand practice in the examination days. Second, in those questions you don't have to do by hand practice, but you have to remember certain key point in that question. Which is the key point? Although you would have done it right, but still to revise, you have to revise it. And the third are those questions which you have to just revise it verbally, which will be only 30-40% of the overall question portfolio. Okay. Okay. Yeah, now let me go. So I hope, Priya, this part is clear. Both certainty and RADR are clear. Then we studied what we studied next. C coefficient, lower hierarchy. Yeah. Then we studied two more things. One is the sensitivity analysis and one is the scenario analysis. Sensitivity analysis, we will change some of the inputs to arrive at the outputs. So on this, we did one question as well. And scenario analysis, we said that we will change the entire scenario and see what is the impact. Now, question number 9 is exactly on scenario. I think scenario analysis only. Yeah. So let us do the question number 9, students. Question number 9 says, PNR Limited is considering a project with the following cash flow. Year 0, it is 12 lakh. Then there are running costs and the savings. So there are running costs to do the operation and then the savings. So final cash flow will be running cost minus savings, right? Savings minus running cost. The cost of capital is 12%. Measure the sensitivity of the project to the changes in the levels of the plant cost. That means the initial capital, running cost and savings, considering each factor at a time such that the NPV becomes 0. So you have to do in such a manner that the NPV becomes 0. Okay. The present value factors are also given. Determine the factor which is most sensitive to the affect the acceptability of the project. Yes, Gajar. Okay, now Gajar is asking. Okay, that's what I'm saying, Gajar. See, in the examination days, I told you to bucket the three parts, but at least in the first, second, or maybe if you go for a third revision also, it is best to do all the questions at once by hand practice. I'm talking about the initial revision. Now, this is the concept building. Now, in the first, second, at least 2 times you have to do the 100% questions proper practice in revision. Do all the questions in modules. Do all the questions in RTPs. Do attempt all the questions that have come in the examination previously. At least uh, for past 5 to 6 attempts. Okay, that will make you properly prepared. And then in the examination days, you can adopt the approach of those three things, right? So first of all, calculation of NPV. So we will take 3 years, right? 0, 1, 2, 3. First of all, the cost of plant is 12. I am putting everything in rupee crores here. So 12 crore. Then running cost is how much? Nil, 4 crore, 5 crore, and 6 crore. This is a negative cost, right? Outflow. Similarly, this 12 crore is also an outflow. Then savings is actually an inflow. 12 crore, 14 crore, and 4 crore. If I'm not wrong, sorry, 11 crore, not 4 crore, 11 crore, right? Now, this is net negative 12, net positive 8, net 14 minus 5, 9, 11 minus 6, 5. And then the present value factor is also given 1, 0.892, 0.797, 0.711. This I have used. And hence the NPV is coming as 5.864. Simple. Now, students, so the NPV as of now is coming as positive at 5.864. Now, first of all, it is asking us to calculate the plant cost. So the plant cost, how much we increase so that NPV becomes 0. So students, 5.864 divided by 12 into 100. That means 48.87 percentage. We can say that plant cost to be increased by 48.87 percentage to make NPV 0. Right, students? In the second part, it is asking for the running cost. Now, running cost will be calculated how? 5.864 divided by what is the running cost for the first year? And the factor for first year is 892. Running cost for the second year is 5. Factor is 797. Plus running cost for the third year is 6 multiplied by 0.711. So the base, the denominator gives you the present value of the running cost, right? As on day 1, as on day 0 actually. So 49.61%. That means the running cost to be increased by 49.61%. Simple. So as to make NPV 0. Then third part, they are saying on savings. So savings 5.864 divided by what is the first year savings? 12 crore, 892. Second year savings 14 crore, 797. Last year savings 11 crore, 0.711. If we solve this, so here the denominator tells you the present value of all the savings, right? So that means the savings has to go down, students, right? To make NPV as 0. So savings to go down by 19.75%. Now, finally, if I tabulate plant cost, running cost, and the last one is savings, 48.87%, 49.61%, and the last is 19.75%. If you change this increase, and this decrease, then the NPV becomes 0. Can we say that the most sensitive factor is what? Is actually savings. Is the most sensitive factor. Why? Because by only changing 19%, it is able to make NPV as 0. However, for the plant and running cost, they have to change higher. That means the NPV is not that sensitive to plant and running costs compared to the savings, because savings only 19.75% can bring a big change in the overall NPV. Okay, student, this was again taken from the module only, this question. Okay, but since this was a good question, because some of you might get trapped in this, that the highest sensitivity is this, which is not right. This is not sensitivity, right? Because ultimately you have to move your running cost by 49.61% to make NPV as 0. That means this is very least sensitive. Right, students? Yes. Now the last part from Soumya. Just a second. Charu had also mentioned, sir, on page number 8.2, in the table of sensitivity analysis, 0 is multiplied by 2.673. From where 2.673 comes? Okay, now let us see. I'm going to the, I hope you are able to see, right? This is a module. I'm going to page number 8.2. 8.2, yeah, this one. I think you are referring here 2.673, Charu. Where are you referring? In the table of the sensitivity analysis, 0. Yes, this row. Yeah, this one. Okay. So this 2.673 would be actually this one you're referring, right? This 2.673 is actually then, Charu, coming from the present value factors. See, what is the discount rate? 6%. What is the age? What is the life of this project? 400 crore, 5 crore, 100 crore, 50 crore. 3 years, right? So for 3 years, if you do the 6% discounting present value factor, it comes as 2.673. Because in the above G step, they have calculated the initial, they have calculated the yearly cash flows. But to calculate the present value, they have taken the 2.673. So they've taken the sum of 2.673. Now, for example, I'll tell you how it has come. In this question we have solved, right, Charu? In this question we have solved. So if you see, these are the individual yearly factors. But if you take a sum of this 0.892 plus 0.797 plus 0.711, this will be present value annual factors, right? The sum of 1, 2, 3. So whatever this comes will be, let's say in that particular question is 2.673 at the rate of 6%. This is the equivalent value that I'm telling you. Okay. Just try it. It would be the same. Now coming to the Soumya's query, question number 4 and 5 and 6. Sorry. Okay, let us discuss the question number 5 and 6. This is the question number 5. Yes, so SG Limited is considering a project Z with an initial outlay of 7,50,000 and a life of 5 years. The estimates of the project are as follows. So lower estimates, base and the upper estimates. Selling price they have given, variable cost they have given, and the fixed cost they have given. Depreciation also they have given, and the corporate tax. Assuming the cost of capital is 15, determine the NPV in 3 scenarios: worst, base, and best case scenarios. Right? So a quick catch here is, in the 5th question, the catch here is, students, if you see there are, rest all everything is fine, but what scenario value to be taken in what is the question. Now, if we talk about sales, the sales worst case will be lower estimate of 4,500. Base case will be 5,000 units. And best scenario will be upper estimates of 5,500 units. Similarly, for the selling price also. So selling price of 175 is the worst. Selling price of 200 is the base. And selling price of 225 is the best. Now, for the variable cost and the fixed cost, the worst will be the upper estimates. So the worst for variable cost will be 150. You're getting my point? The worst for fixed cost will be 1 lakh. So this is the only catch in the question. Okay, Soumya? Rest all you plot the numbers and calculate it. Answer is simple. Just refer the solution given in this. Now the next question, question number 6. New Projects Limited is evaluating 3 projects. Project 1, Project 2 and Project 3. And the following information is available in respect of these projects. Cost 15, 11, 19. Inflows. Minimum required rate of return is 15% and tax rate is 40. Find out the RADR for these projects, which project is the best. So they are asking us to calculate the risk adjusted discount rate. So that means we have to calculate the IRR of this. So now students, if you see, okay, I'll tell you. They are asking us to calculate the IRR. Now see, the risk index is also given. Okay, let us go to the solution and then we'll see quickly. The risk-free rate of interest and risk factor for each of the projects are given. Okay, the risk adjusted for can be found on the basis of CAPM. Okay. Okay, just a second. I think we're applying something else here. Just give me a second, students. Okay, now let me explain this part as well. Got it. So, students, I think all of you know what is CAPM, right? I think this is a new thing for me as well because I have not covered this part. Good, Soumya, you asked. So, students, if you see what is CAPM, right? CAPM is actually the index. Okay, this beta is actually the index. Now, if I go back here in the solution, so 10% is already given as the risk-free rate of return, which is 10%, and 15 is the overall factor, and the risk index is 1.8, 1, and zero point 0.6. That is what is given, right, students? So using that, the risk-adjusted discount rate is being calculated. Okay, and after the RADR is calculated, the same RADR can be used to calculate the NPVs of the different projects. Okay, yeah, I think that here the only catch is that because we have been given the risk-free rate and the overall rate, hence we have taken the risk index and calculated the risk-adjusted rate. Memin is asking sensitivity analysis. Okay, let me explain the sensitivity analysis again. So, sensitivity analysis, can you just see this slide? We said that there are different types of inputs, right? What if we change one input and try to see that what is the impact of NPV? That will give us that NPV is sensitive to which all factors. Okay. Now, if small change in one factor is changing NPV to a larger extent, that means the factor is sensitive. That means the NPV is sensitive to the factor. Simple. So in sensitivity analysis, we will keep on changing the variables and try to see that what is the impact on NPV. We will keep on changing some of the factors. Let's say we will keep on changing revenue, keep on changing discount percentage, keep on changing time, and we will try to see that what is the impact on the overall numbers. So students, with this, both the topics from my end comes to an end. And thanks a lot, students, for asking very good and very intellectual questions. And I wish you all the very best in terms of your preparations. Please do revise well. And please do reach out to us in still you have any query. And please go through the revision as well. Okay. So thanks a lot, students. Technical team session concluded. Yes, Ramji. Session.